Welcome back to you all. Now we will start the second topic, income statement and the overview and the comprehensive example. We will take these two topics simultaneously. Now coming to the topic, uses of the income statement and terminology. The purpose of the income statement is to provide the information that about the uses of the funds in the income process, that is expenses, uses of the funds that will never be used to earn income, losses, sources of funds created by those expenses, revenue, and the sources of funds not associated with the earning process, gains. Let me make you understand all the 4 points that are we are going to call them from now onwards regal. R for the revenue, E for expenses, G for gains, and L for losses. Before proceeding the regal part, what is the purpose of the income statement? Income statement purpose, normally it indicates the performance for a period of time. It also determines for the operating risk. A financial analyst is able to check the same, that whether the company sales are relatively stable from one period to the next or the volatile. Is it operating income relatively stable or volatile? So let's understand the regal with an example. Like if we spend some money, like if we buy some inventory and then sell it, so the inventory comes under the expense part, sale comes under the revenue part. And if we incur some expenses which does not generate any income, that expense comes under the losses. And if we get something in return without expecting it, or without any operating process, without any earning process, if we get some money from that is all called the gains. I'll remove the same. Come back to the uses of the income statement. So income statement is useful in determining the profitability, value for the investment purpose, and the creditworthiness. The income statement is also useful in predicting the information about the future cash flows, timing, amounts, uncertainty of cash flows, and based on the past performance. So who are the users of the income statement? First is external users. Who are they? They are the investors, stockholders, common or preferred stockholders on income statement. Basically, they use our income statement to evaluate our company on the basis of profitability and the operating income. Now the second is lenders. They could be the short-term lenders or the long-term lenders, and they evaluate our income statement to check our company's creditworthiness. What factors they look into the income statement? Our profit margin, our EBIT, and if higher the EBIT, higher the credit rating. Now the internal users like the managers, they evaluate a company's return on the basis of ROA, like return on assets, or for a particular product line. So basically all the users, like ELI, external lenders, and internals, are all are concerned with the risks in our income statement and the volatility in sales and operating income. All these three users check the risk in these two parts, whether they are volatile or not. Now come on to the concept of regal. REGL. Got it? So what is revenue? Revenue is reported in the gross amount of the considerations to which the entity expects to be entitled in exchange for the goods, specified goods and the services transferred. Basically what they are saying is, whenever we transferred some goods or the services to the customers, in return of that we get some amount, and that is called the revenue. Basically, if we are sell some inventory in our business, if we are getting money in exchange of an inventory, that money I am getting is called as revenue. What are expenses? Expenses are cost that benefits only the current period, and the allocation of the unexpired cost to the current period for the benefit received are reported at their gross amount. What they are trying to say is, the cost we will be adding in the income statement will belongs to the current period only, or if we have already received the services in exchange of the expenses, then if we hadn't paid the amount, we also had to include the unexpired cost of the current period. What are gains? Gains are reported at their net amounts. Proceeds less book value. A gain is the recognition of an asset either not in the ordinary course of business. Example, gains on the sale of fixed asset without the incurrence of an expense, and finding gold on the company's property. This is a very easy language. Maybe, I hope so, you are all getting the understanding of the same. So what are the losses? Reported at their net amounts. Proceeds less net book value. A loss is cost expiration either not in the ordinary course of the business. Example, loss on the sale of investment assets or without a generation of revenue, that is abandonment. Example of this, an old asset has been sold in scrap, that is called the abandonment, or if it is not using in the business, then the value of that need to be write off, so that will come under the part loss. Or if we have sold some investment, right, investment at loss. So other thing you need to keep in mind is, these two are on net basis, these two are on gross basis. What does it mean? First let me remove it. Okay. Now what is gross concept is, let me make you understand, like if we have made sales, there will be some sales return, we subtract it from the sales and we get some net sales. As it is from the operating business, we will call it a gross concept. If we look at in the Indian system, we call it a net sales and we assume it is a net concept, but keep aside the Indian concepts, just focus on the CPA one. In USA, if something is shown in the operating side of the income statement, then it will normally called as a gross concept. It is not the exact concept I am telling you, it is just a part. So hope you understand the same, that net sales is not a net concept, it is based on the gross concept. Gross concept, why this is called the gross concept? Because all the sales, the final sales value has been come here. Do not consider it as a net concept because we have subtracted the sales return. Keep this in mind, it is a very important point. Many MCQ has been come in the CPA exam. Now the expenses also comes under the gross concept. If we look at the overview picture, net sales minus cost of sales comes as gross margin. So net sales comes as revenue, cost of sales comes as expenses. So as here is a gross, so we will call both of them as a gross concept. Hope you understand, hope you will learn it for the exam. Let me remove it. Now what is net concept is, in net concept gain on sale of furniture. We are taking an example, okay? Sales minus book value, sales proceeds, gain. This comes under the net concept. Basically in a single word we are getting two things: proceeds and the expense, proceeds and the cost. So if we are getting in the single word two headlines or the two items, then we can say it in a net item, on the net basis. Same goes for the loss. There will be two items in there, it could be gain or the loss. Please excuse my writing, I am just making you understand. Now third point is both of R and E, revenue and the expenses, are divided into the two parts: operating and non-operating. Operating means they are mostly the part of the normal operating activities. They are put separately on the income statement and presented as a gross amount, which I have made you understand. Non-operating means they are the part of exceptional and the non-operating activities like the interest revenue, right? If we have made some bank deposits and we are getting the interest on that, it will come under the revenue head, but it is a non-operating part. And the same interest can be the operating in case of bank also. This is important. For G and L, gain and losses, only one important point is they are capped on the net basis, and R and E capped on the gross basis, gross concept. Now the important point: income, items on income and loss that are unusual and infrequent. Learn these words: unusual and infrequent, or both. An item can be unusual or infrequent, should be reported as separately as a part of income from the continuing operations. The nature of the item and the financial statement effect should be disclosed on the face of the income statement or in the footnotes. What are they trying to say is, if you know the previous financial structure, in that if we find something unusual or infrequent, they are considered as the extraordinary no extraordinarily sorry extraordinarily earlier, but now this concept has been abolished. Now all the items, whatever is unusual, infrequent, or both, all comes under the non-operating item. Understood? Yes, ma'am. Now come on the terminology cost and the unexpired cost. Cost is the amount measured in money expended for the items such as capital assets like furniture, service, payroll, merchandise received. Cost is amount actually paid for something. Unexpired cost are costs that will expire in future period and be charged, allocated in the systematic or the rational manner, or matched against revenue from future period. Basically, what is cost is, we call it as a period cost. If you see a period cost name in the question, consider it as a cost. What does the period cost means? It is an expense which is incurred immediately and they are recurring in nature. Example: selling cost, journal cost, administrative cost, research cost. All these costs are happened recurring in nature and they are expensed immediately. What is unexpired cost? It is a cost that is capitalized as an asset for the future. Basically, if you have purchased an asset, it will be considered as an unexpired cost for the remaining of the years which you will be using in the future. And these type of cost basically will be expensed in future periods according to the matching principle. If you let's take an example. Assets are depreciated over time, keeping the useful life in mind. So while applying the depreciation, we are following the matching principle. Now what are the examples? Like unexpired costs are normally called as assets. We have bought an inventory. It is not expired. We haven't sold it yet. It is converted into an asset and it will be transferred to cost when we have sold the item. And that, if you see the inventory, if you see the journal entry for the sales item, first of all we transfer the inventory to the cost of goods sold and then we will sold it, right? So whenever we sold the inventory, we transfer the expired cost in the name of cost of goods sold. Unexpired could be a prepaid cost for the of insurance, and when we paid the premium, that is unexpired cost. But when we get the insurance, when we know that we are not getting anything in return, it will be an insurance expense. Net book value of fixed assets is unexpired because we are going to use it in future, and the depreciation we have used in the future in the year, so it is unexpired. Unexpired cost of the patents, basically the book value which we are going for the future, Basically, if you buy an patent, it could be for the 10 years or 15 years. Let's suppose 5 years has been down, then the remaining 10 years or 5 years as per the category, it will be amortized over the years. So the amortization will be expired cost. Now we have done with the purpose, uses, terminology done, regal concept done, gross concept done, net concept done, notes done. Now income from the continuing operation. Before that, non-operating items. Let me tell you the examples of non-operating items are called as write-down, write-offs, sale of PPE, property, plant and equipment, sale of investment in another company, unusual operating expenses, or sale of anything other than inventory. They comes under the non-operating items. Now income from operating expenses. You need to write it down. Income from continuing operations equals to operating income. What is this? R&E plus non-operating income, that is G and L. Hope you understand. If we check on the previous pages, R and E are the gross amount plus the operating part. Okay, G and L are the non-operating part. The nature of the item and the financial effect should be disclosed on the face of the income statement or on the footnotes. It is the same we have learned here. So we make the income statement at two steps, two models, 1 and 2, that is single step and the multi-step. First, this is the multi-step. Before that, for non-operating items, only the net result of the transactions like the gain or the loss is reported and not the gross amount. So write it down. Net gain or loss, this is important, you need to write it down. Selling price or NRV minus book value or the carrying value. Income from operating continuing operations, I have write it down here. Let's check what is multi-step income statement. This is the concept. This is an example, like we are given the trial balance, and from that trial balance we need to make the multi-purpose income statement. We will learn it, understand it. Now second part is single step income statement, and in single step example is the same, and from that trial balance we need to prepare the single step income statement here. And the second part is income from discontinued operations. So when we selling off an product line or the division line, product line or a division line or a segment of a company's operation, the income from discontinued operations are normally reported separately. Not normally, it is a kind of mandatory. Like if you see here, discontinued operations, if you see in the multi, it is a multi step. Discontinued operations always considered as net of tax. Also here net of tax in both the amounts. In both the models we show them separately. Now before going to the example, let's take an overview. Let me make you understand. First you need to write down something for the income statement. Write down formula. In single step it is all revenue and gains. All revenue, it could be operating, non-operating, everything, interest, sales return, everything, minus all expenses and losses. All the expenses means all the cost of the goods, depreciation, selling, income tax. This is also an expenditure for us, right? This income comes as pre-tax income, then less the income tax. Though it is not shown as a separately here. If we see the question, we can see there the income tax is not shown as separately here. They are shown in the all expenses category only. It comes as net income. This is the formula you need to remember for the single step income statement. Point is this, that income taxes, this is important, that income tax in the question we need to show here in the all expenses category. Now for the multi-step income statement, there is also a formula you need to learn. Let's write it down where. Write it down here only. Sales minus cost of goods sales. Here we come as gross profit, then minus operating expenses. We are coming at the operating income minus non-operating. What are the points in regal? They are G and L, gains and losses. Now we come at pre-tax income minus income tax. We come at income, net income. Then we will add or minus the discontinued operation, which is already net of tax. Then net income. So what are the pointers here? This is net of tax, number 1. Pre-tax income is from the continuing operations. Are you writing down? Let me write it down for you. Number 1, this is net of tax. This income is income from continuing operation after tax. This is income from continuing operation but before tax. Here comes at regal part from non-operating items like write-offs, write-downs. This shows the performance of operating business, like the core business, whether it is sustainable or not. Operating expenses include, where I write down, operating expenses include selling, journal and administrative head, depreciation or amortization, R&D, etc. Hope you have write it down. Okay. Now we will do the benefits and the drawbacks of both system. In single step, what is the benefit? Benefit is, it is simple. It is a simple model. It does not make one item appear more or less than another, right? In this item we give importance to all the items equally. Importance to all items. What is the drawback? That it does not distinguish between the core business and the incidental business. And now comes at the part of multi-step income. It has only benefits. What are the benefits? There are 3 benefits. First, it enhances the user information. Like if we check the statement, we get many things. What we are, like if we see here, what is the gross profit, what is the operating income, what we are getting from the core business, like the profit from the sales and purchases, what we are getting, what we have lost from the non-operating income, what tax we have paid, and the total amount. We are getting the more information, so it enhances the user's information. Second benefit is it separates the operating business from non-operating, and it provides readily available information for the ratio analysis. Why ratio analysis? I will make you understand in the question. Now there is one topic left that is not in this book, but I have learned that topic from the Becker material and the Becker's professors. So that topic is limitation of the income statement. Like what are the problems we need to check as a financial analyst while we are checking the income statement of a company. That is the limitation of the income statement. Let me write it down so I do not forget. Here, limitation on of income statement. This topic need to be done before fourth topic, income from discontinued operation. Now let's come back to the question. This is our question. Before that, I need to make you understand that in CPA, for all the items there are given some universal code, like for four numbers, 4,000 are for the revenues, 5,000 are for the expenses, 6,000 are for the other revenue. Basically that is a part of G, and 7,000 is a part of L. Loss, restructuring expenses, interest expenses, non-operating item. I have told you, interest expenses is considered as a non-operating expense. And 8th is important. It is for the loss on discontinued operation net of tax. It is already given, so thanks to question. Let me remove it. Hope you have write it down. Now let's do the solution. First, what I have told you, first find out sales. Sales 380 minus sales return minus sales discount and revenue. This is important, we include the rental revenue in the business only, plus but we come to $380 minus 225 minus 5 plus 200 plus 100 comes as $650, right? We can check it here. Net sales minus discount comes at 650. Now what second item, what I have told you, cost of sales. How do we now comes at the expenses part. Expenses are this much. What is the cost of goods sold? We include cost of goods sold this 200, cost of services sold because we have sold the services also 150, cost of rental income we will use it because we have also taken the rental revenue. So all three comes as 410 dollar. We can check it, $410. Now gross margin we have subtracted from 650 minus 410, that is comes out at 240. Now after that I have made you write the operating expenses. In the operating expenses we can see salaries expenses. In salaries expenses 70. In salary expenses $20 relates to the salaries for salespeople. Salespeople means this is an advertisement expenses, like advertisement. And $50 relates to the salaries for the officer. Salaries for the officer means it is for the general administrative expense. So this divided into two parts. $20 is sales and $50 is for general and administrative. It is sales. Now freight out is also selling expenses. Commissions we give to the people who made our sales, so this is also on selling expenses. Advertising is also on selling expenses. So what the total selling expenses is this much. Selling expenses is 225 plus 40 plus 15 plus 20 comes out as $100. Okay, now general and administrative, this is important point. Insurance expenses comes under the general and administrative part. So what is the now second item will be taken at general and administrative part as 20 plus 50, that is $70. Okay, now in depreciation, the depreciation item is 80. Third item will be depreciation and $80. So what are these? 170, 80. Selling expenses 100, general and administrative 70, depreciation 80. All these are operating expenses. We have subtracted and we get a loss from the income from operating income. Right, now we will add the third part, that is non-operating gains or losses. Now I have told you income tax expenses will be used later. Now comes at the revenue part. It is a non-operating. 170 income add. Other revenue is also non-operating. Income add 170, 130 plus gain from the available for sale of securities. All three items will need to be added. 170, 130, 50. 170, 130, 50. Other income, gain on sale of securities, interest income. Right, this is the income from the non-operating income. Income comes at 350. Now subtract the expenses. Interest income, loss, and what we have called about the restructuring expenses is it is related to the infrequent. Have you remember the word infrequent and unusual? Here, items of the income or losses that are unusual and infrequent are considered as non-operating item. Okay, so it will also comes under the non-operating item. 100. We are from where we will get to know this, that it is an non-operating item from this word infrequent. So 50, 40, 100. 50, 40, 100. This is the expenses. This is the income or loss from the operating. This is income from non-operating. This is income from non-operating. Now after we will add in this and subtract from this. Now all the expenses we have done it. Now after that we will subtract the income tax expenses, that is rupees 100. It has also been written here. Rupees 100, and we get the total profit. Here we use the word income from the continuing operations, that is $50. Now discontinued operations is also given in the question under the 8000 series. 8025 loss, and this is already net of tax, so no, we do not need to subtract the tax amount from this. Okay, so now minus 25 and net income is 25. Got it? Now, I have told you earlier that we will do the ratio analysis as we get the benefit from the income, right? Multiple step income statement. So, what does that mean? Let me make you understand. So, if we do the ratio analysis on this question, we will do journal margin. This is 240 upon my 650 comes out as, what is the journal margin? 3.7069%. What is this? It is a gross profit margin. What is the formula? GP upon my net sales. Why we are calling it net sales? Because they are after the less discounting, after deducting the discounts and the returns, not the cost. Now we are getting around the 37%. We are getting around the 37% of the gross margin. Now what is the operating margin? This is the operating margin. How we will calculate it? 10 divided by 650. It is comes at 1.5%. Even in negative, as it is a minus, right? 10 is negative, so it is a minus 1.5% in negative. So if we analyzing the statement as a financial analyst, we can see, we can raise the questions. If we are getting the gross margin 37% as a profit, then why we are getting the net profit in the negative? Is there any something happened in the market for the industry overall, or only this company is suffering from this? Now total income we got is 150 and we paid the tax. So what is the effective tax rate? Hundred upon my 150 is, it is not written here, 66.67%. Now if we are seeing the ratio, do you know any country where we paid the tax more than 30 or 40%? No, right? So if this company is paying 66% of the tax on the income it has earned, this is a major red flag. We will do not do the business in that country. We will be dead if we are doing the, if we are paying the 66% of our income, right? Now comes at the 25 net income. So what is the profit margin? Is 25 upon me 650. That comes out as, it is not 200, something wrong. $25 upon me 650 comes at 0.038%, right? Means 3.8%. Now we can see that if we are getting the negative figure here and we are getting the plus figure here, so what are the incidental income we have earned this year? Are these the major income? Are these the, will this be recurring every year? Though non operating income does not occur every year, but we can check the situations and the conditions and can analyze the same. So this is the benefit of doing the ratio analysis, that we are getting to know if the company is getting a good image or the bad image, from where it is earning the money, from where it is getting the income, how profit margin is good, whether the company will sustain the profit it is earning in the year. Let's suppose they are earning the 40 to 50% profit. If their profit margin comes out at, if they come out at 40 to 50%, so will the company survive the same profit in the next year or the furthermore years? We keep all these questions in mind while analyzing the income statement. Okay, what is written here? Selling expenses exclude freight out. Okay, let me tell you about the freight out and freight in method. So here is the freight out. Freight out means when our goods are removed from our godown and sent to the supplier or to the customer. So we paid the freight for the transport to for the selling, so it is an selling expenses. Okay, but if there is written here freight in, if it is written here in, it means it will be added in the raw material. It is a part, it will be capitalized in the inventory. Like we have purchased some inventory or the asset, whatever it is, and we booked a tempo or a car or a transporter to make it arrive at our godowns. So we paid some freight on that, and that freight amount will be added in our inventory or the asset we have purchased. So it will not be if freight in will not be considered as selling expenses. Okay, this is the important part. And now selling expenses include freight out, salaries for salespeople, commission and advertising. I have made you understand already. General and administrative expenses including the officer's salary and the insurance. This is the important part. Non-operating revenue and gains including the auxiliary activities. What is this? This is the when we like if in a factory you can see the spare parts, they do not directly use, but they will definitely provide the assistant in the future, or they will be used. Like whatever the items we keep in the company or keep in the factory or whatever area we are using to support the provisions of the services, including like current station services, batteries, powers, control cable, whatever we are using to provide the main services, as an it is kind of the helping activities or the helping items we are using in the company. Now multi-income statement has been done. Comes to the single step income statement. Here only we have write down all the revenues here: sales, service, interest, which is non-operating item in the previous model, rental income, gains on sales of service, it is also in the non-operating. Other revenue, we have included all the items here, comes out as $1,000. Then we subtract the expenses: cost of goods sold, cost of services, rental, selling expenses, general and administrative expenses, interest expenses, depreciation, loss on sale, which is a non-operating, restructuring, non-operating, income tax. I have told you now that we do not show the separately, it just we include in the expenses head. 100 total expenses is 950. Income from the continuing operation is 50. Now discontinues always need to be shown as separately, that is after net of tax, 25. Let's suppose in this case we do not have the tax rate. If we do not have the tax rate, then how we will calculate the income tax expense here? We will calculate the effective tax rate from this method. Effective tax rate, we have given the amount, right? Effective tax rate is 66.67%. So we will If we remove the 100 from the expenses, it will be $850, right? So 100,000 minus $850 comes as 150 profit. Now on that we have to pay the tax. What was the effective tax rate? That is 66.67%, which will come out as 100. We will use that. We will calculate the income tax accordingly on the basis of effective tax rate. Now this is already given. The same answer we have received in both the models. Now we have done with the topic income statement, income statement overview. We have done the comprehensive examples of both the models, multi step and single step, right? Now the second topic, and now the next topic will be discontinued operations, introduction and accounting rules, and discontinued operations comprehensive example.